7 years after the financial crisis, there's little to show for efforts by the government to bring charges of illegal activity against Wall Street's largest banks. The Wall Street Journal examined 156 criminal and civil cases brought by the Justice Department, the Securities and Exchange Commission, and the Commodity Futures Trading Commission against the nation's largest banks going back to 2009. J.P. Morgan Chase, Bank of America, Citigroup, Goldman Sachs, Morgan Stanley, and Wells Fargo, along with 4 European banks with large U.S. operations. The analysis showed the government has rarely brought charges against individual bank employees, and in cases when individuals were charged, the government has rarely won a case. Since the end of the financial crisis, the government has charged a total of 47 bank employees with illegal activity, about half at junior or mid-level positions. Most of the charged bankers pleaded guilty to criminal counts or agreed to settle a civil case. Those who settled paid a median penalty of $61,000. But of the 11 people who went on trial and had a ruling on their case, 6 were found not liable or had their case dismissed. That leaves 5 employees against whom the government won contested cases. In one case, Gary Hines, a former UBS employee, was sent to prison in 2013 on charges of rigging bids tied to the municipal bond market and is scheduled to be released in July. Another, involving mortgage fraud charges and a $1 million penalty against former Countrywide financial executive Rebecca Marone, was overturned by a federal appeals court this week. Plus, a related $1.27 billion penalty against Bank of America, which absorbed Countrywide, was thrown out as well. So why hasn't the government been able to bring more successful cases against banks and employees? It turns out much of the institutional conduct during and after the financial crisis was deemed not to be illegal, and in cases where illegal activity was proven, it was rarely traced to upper management.